Okay, let me start. So I'll be starting, and today topic I might be rushing because I'm a little bit tired. I didn't sleep very well yesterday night, so I want to sleep. So I might be rushing. So just try and understand. It's very simple. At the same time, it's very easy. It's a simple. There are two simple concepts I want to teach you today. So the first one I'll be talking of is what imbalances in the market. Imbalances in the market. Imbalance. I'll be talking on imbalance and mitigation today. Imbalance and mitigation. So firstly, I'll be talking on I'll be talking on imbalances. Why is my phone doing like this? I'll be talking on imbalances. What are imbalances? What are imbalances? If I will ask, what are imbalances? What are imbalances? What are imbalances? What are imbalances? Imbalance simply means gaps in the market. Gaps that price must go back and fill. Gaps that price needs to fill for the market to continue. There is just like when a clear example, different scenarios. And imbalance is very important because imbalance give you precise location of where the market can reverse from. Imbalance is precise location of where the market can reverse from. Precise location of where the market can reverse from. I'll be giving different scenarios. Different. Please pay good attention. Pay good attention. Pay good attention. So I remember I told you imbalance. There are gaps in the market, and imbalance is mostly associated with pressure candles. Remember I told you what pressure candle is. When like example now is this candle here. This candle now is what we call pressure candle. Is what we call pressure candle. And this candle is mostly associated with imbalance. The candle is mostly associated with imbalance. So get that right. That's just the simple definition of imbalance. And so how do we know imbalance? How do we know gaps, imbalance in the market? So I'll start from here. So from here now you get clear understanding. And remember I told you anytime you're looking for imbalance, you're looking for pressure candle. You can see a pressure candle here. You can see a pressure candle here. Sorry, you can see a pressure candle here. 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 You can see another pressure candle here. So those pressure candles they cause what we call imbalances. You don't and always take this fact, always take this note. Price always goes back to fill an imbalance, to fill a void. Okay, how do we know imbalance gap? Pay close attention. Let me explain for you. Okay, now imbalance gap is being is being explained by open by the high and the low of two candles, of two previous candles. Let's come back. Let's start from the beginning. You can see at this point now. At this point, you can see this is a bearish candle. You can see price opened at this point, then price opened at the top, then closed at the bottom. The next price opened here. So I expect price to come back and fill this void that is from here and fill this void. Where is it? Okay, I think that is on the 4 hour. Ah, how am I not seeing anything? Okay, let's use this as example. Let's use this as example. Let me add two lines so you understand. Oh, better still, let me start from back. Let me start from back. It's easier that way. It's easier that way. It's easier that way. It's easier that way. I'll be using just these two lines to explain imbalance. Imbalance is a very simple concept. Imbalance is a very simple concept. And imbalance deals with two candles. It deals with take note, it deals with two candles. So and I told you you can take any candle and check for imbalance. But anytime you are seeing pressure candle, there's definitely there it is there. Anytime you see pressure candle, you know for sure that there are imbalances at that place. Okay, what are imbalance? Imbalance just simply means, okay, now if you look at this candle as a whole, this is the candle, the last candle, taking the last candle, we are trying to check for imbalances there. We are trying to check for imbalances there. Taking the last candle, we can see that price, okay, I'm still thinking of a better way to explain imbalance. Okay, let me, I can't use here because this is not trading view. So let me use here. Let me use here. Let me start from this candle here. Okay, from this candle, this red candle you are seeing, this red candle you are seeing. I'm expecting two things. In imbalance. I'm expecting two things. First, okay, and I told you we are using two candles. I want you to get the concept very well so you understand what imbalance is. Because if you can understand what imbalance is mean, you are 70% there, because you can accurately give pinpoint areas in the market where price will go. Because when you mix imbalance and order block, that's what I told you on WhatsApp, that creates imbalance. Once you join order block and imbalance, you see the great deal. You see how effective markets tends to work with imbalance. Okay, now taking this candle as a whole, we saw that this candle all the way down, don't forget we are taking this candle, we are taking this candle here, this candle here. We can see that, and we are taking three candles. Sorry, I say two candles, three candles. Three candles that must cover each other perfectly. That is, the body must not be exposed. What do I mean? Okay, if you check this previous blue candle before this red candle down, before the red candle down, what can you see? You can see that immediately, I'm talking of imbalance now. I'm talking of imbalance. Imbalance and mitigation are almost similar, but they are different. Okay, now you can see that this blue candle before this red push downward, you can see the blue candle there. So you will mark the close of that blue candle, the open and the close of that blue candle. If you, let's mark that, so that will be this place and this place and that place. So that is the open of that candle. That is the open and the close of that candle. So the next candle now, we are looking for the close and the open of the next. We are looking for the close and the open of the next candle. So let me mark that. The next candle now is that bullish candle. So this is the open. Let me signify it. I want you to get a better understanding on imbalance. Imbalance might be hard to understand, but once you've gotten the concept, so okay, this was our, so the open and close of the market from here to here, there, this point. So what are we looking for? We are looking for exposure of the immediate candle. This blue candle closed at this, at the red line. The low, sorry, the low of the blue candle was at the red line, was at the red line, was at the red line, was at this, was at this red line here, this red horizontal line here. And you can see the close of the next candle was at this point, was at this point. Let me put it very, let me use my, was at this point, was at that point. So you can see there is a gap, there is a gap there, there is a gap there, there is a gap there, there is a gap there. Look at the gap. I don't know if you are getting what I'm saying. There is a gap there, there is a gap, there is a gap here, Look at the gap. There is a gap from the close. I don't know if you are getting it, if you are seeing the gap that I'm seeing. No, you can see that gap. Let me change it, change the color to green. Okay, you can see that gap from that low of my blue candle till that body at that place is exposed. That is what we call imbalance. If I explain mitigation, you will understand the concept of imbalance. But that is just what we call imbalance. And what price, you can see price left imbalance there. That space now, price needs to go back and fill that space. Price needs to go back and mitigate that space, fill that space. Needs to Price needs to come. If it rally down and didn't fill it, it needs to go back, fill the space up to this point or up to half, then come down to rally down. Price needs to fill that imbalance to rally down, or mitigate it to rally down. One of those two. Price needs to fill the imbalance to rally down or mitigate. And you can see, this was the lowest point here. This mitigation, this was the lowest point. You can see that price actually went back to mitigate it, just to rally down, So that is just the concept of imbalance. So that is how we do imbalance. That is the imbalance for this candle. Okay, now taking the next candle, we are just taking the next candle, You can see the open and close. The open and close for this candle now is this. Can see, I'm talking of imbalance now. Can see this is the open and this is the close of the next candle, right? We are looking for imbalance at that place, want to or not. That is the open and close. Then if you come to the next candle, the next candle opened at this point and closed at this point, So you can see, you can still see our imbalance here. We can still see our imbalance here. They can still see that there's still imbalance here. So my imbalance now is from the lowest point of that low, from this lower point of this previous candle low to the highest point of the next candle. Imbalance, let me explain imbalance in details. Let's say, I don't know, arrow. I'm not seeing arrow here. Arrow line. Okay, let's I'm coming. I want to explain the value, the concept of imbalance is very well. Okay, okay. Now let's assume you have a green candle. Let's, let's assume you have a green candle here. You have a green candle here. Imbalance is just gaps in the market. It's just gaps in the market. I don't know. Like seriously, I don't know how to explain it. I don't know how to explain it. Price must feel imbalance. Price must feel imbalance. Price must feel imbalance. Here now, you can see. Here now, let me delete everything. Here now, the next candle. No, we've done for this candle. We've gotten the imbalance here. The next candle now, can see, and remember I told you imbalance we are dealing with three consecutive candles. You can see that the next candle came here. The low was at this point. Session opened. Session opened at this point, went up small, then came down. So we are looking at the body, the body of the imbalance. You can see that at this one, the next candle, the next candle, did you feel it? There is just a small imbalance gap following the next candle, so it's negligible. It's negligible.
Going to the next candle. So next candle now will be this and this. So you can see the lowest point of this candle is this, the highest point of this candle is this. So if there is gap between them, okay, let me use this concept to explain it. Once there are three candles, you check for you'll be checking three consecutive candles. If it's in an uptrend, you check if, okay, now for this candle now, three consecutive candles. First thing, you check for the low. If it's in, sorry, let me use downtrend. So for uptrend, you know how you fix yourself. For a downtrend now, the first thing you check for, you pick any three candles into consideration, in three consecutive candles into consideration. Okay, you check the first candle. You check. We are talking of downtrend now. I'm using downtrend as an illustration. Check for the lowest point, the low of the first candle. You check for the low of the first candle. If the low of the first candle and the high of the second candle did not meet at one point, they must meet of the first candle and the high of the second candle. They must meet at one point. I say second candle, last candle. They must meet at one point. What do I mean? What do I mean? You can see here. You can see here that this is the we are taking. Let's take this one, two, three, for example. You can see that the low of this point, which was this point, the high of this is this point. That's high did meet this low. So there is imbalance. That space there is an imbalance already. That space there is an imbalance. So till when price come back and cover this space, then that imbalance void has been covered. Here now, we are taking. Let's take these three candles. These three candles. This is the low of this point. This is the low of this candle. This line. That is the low of the candle. Then the high of this candle is here. You can see that there is imbalance. And what do you see price did? Price came back or after the third candle. You can see that the imbalance, price came back, filled the imbalance up to this point, up to 50% or 60%. Price always feel imbalance up to 50 or 60%, then started rallying down. That is just the concept of imbalance. I don't know how to explain further. That is just the concept of imbalance. That is just you do it, or you check for it. Why is imbalance important? Imbalance is important because it's very powerful. You can see price perfectly. The low, this is the high of the last candle, and this is the low. What do you see price did? So that gap there is an imbalance. I remember I told you order block. So my order block now will be here. So this will be my order block. This so my order block will be this red candle, this blue candle, sorry, this candle here, the candle that caused that order block. And you can see that this candle matched all our requirements. It matched all our requirements. It matched all our requirements. Can you see? 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 So that my order block now is valid. And what can you see price did? Price still went back. After price came down, created different imbalances, because there's imbalances here. There's imbalances here. There are different imbalance. Price came back, still went back, entered, filled that imbalance, and touched my other block, then rallied down. So that is why imbalance. Once you mix imbalance, block is another strategy. So you can see. Oh, let's not even go far. Let's not even go far. Let's take. Can you see? Can you see at this point? Can you see at this point? After price has rallied down a little bit, price went back up, filled the imbalance. Immediately it filled the imbalance. Can you see? Can you see what I'm saying? Immediately price filled that imbalance up to this point. Can you see the way price rallied down? So imbalance must be filled. Once you've located an imbalance very close to another block, so we are not looking for imbalance at all places of, we are looking for imbalance that is close to our other block. Just the way we are looking for liquidity close to our other block, we are looking for imbalances too that is very close to our other block to give us confirmation, to tell us that yes, there's mitigation here, which I will explain very soon. There's mitigation here, so that mitigation caused an imbalance. So price needs to go back and fill that void. Is a void in the market. That imbalance is simply telling you that there are orders there, and it's the banks that created those orders. And since the bank don't want to lose money, they have to go and break even at that point. They have to go and break even at that point to be able to recover their losses. So the price needs to go back and fill those points. Immediately price fill those, the price continues down. It continues to where it wants to go. That is just the simple definition of imbalance. That is just the simple definition of imbalance. I don't know whether you understand what I'm saying. That is just the simple definition of imbalance. Imbalances work. That is the way imbalances work. That is the way imbalances. That is the way imbalance work in the market. And can you see? So from just from here to here, we would have made enough profit. We would have made enough profit. And price reaching here now, price getting here, price getting here, price getting here. Can we see another block here? Yes. What is another block? Here now is this red candle. Can see the way the candle is very small. This candle here is this candle that caused this move up. And characteristics of the candle, what did I tell you? There must be break of structure. You can see this candle broke this previous structure up to this side. Yes. Is there imbalance? Is there imbalance? There is no imbalance. There is no imbalance. Why is that? Okay, let's take this candle. One, two, three. I told you for a downtrend, the low of the first candle and the high of the second candle must meet. But this one, for an uptrend, the high of the first candle and the low must meet. It's just the difference. Okay, here now this is the high. This is the high of the first candle. Can you see that price, immediately price went up, price came back with this long wick to fill it, filled the imbalance, filled it, then took price up. If you are taking this, we are taking one. What is all this? If you are taking, if you are taking, if you are taking one, this the following three bullish bars, you can see the high of this place is here, the low of this place is here, and you can see that price has already filled it. That is right. So if you take this one now, the high of this place is here, the low of this place is here, there's imbalances there. You can see price came up, filled the imbalances up to this point, then rallied up. So there's always imbalance. And anytime you're looking for imbalance, I've told you, you look for big candles. Look at a good imbalance here. Look at a good imbalance here. You can see this is the high of this candle. This is the high of this candle. This is the low of this candle. So that there is gap here. There is gap here. This gap here is an imbalance. But price will definitely go back to fill that imbalance. And what do you see price do? Went back, filled the imbalance, went back, filled the imbalance, then took price up. So we expect price to always come back to fill our imbalance. Anytime we are seeing imbalance in the market, it's telling us, it's telling us that price will go and fill it, that price will go and fill it, that price will go and fill it, that price will go and fill it. Imbalance are very important, very, very important. Here now, this and imbalance, I told you, you always look for imbalance for pressure candles, not small small candles. Okay, now you can see this bullish move. Let's, if we take the three candles, this is the low, this is the low of the first candle and the high of the next candle. Can you see that imbalance? Can you see that imbalance? Can you see that imbalance? And what is it? After price came back, entered the imbalance a little bit, then fill the imbalance, then feel the mitigated that imbalance. mitigated that imbalance, came down, then filled that imbalance to take price up. That is just the simple concept. So presently now we can see imbalance. If you can cite the imbalance here now, I think that is a good thing. So let's use live example. Let's use live example. Let's use live example. Let's use live example. See this Euro USD is a very good potential trade with lots of positives there. Okay, now yesterday if you watch, I identify this as my order block. Identify this as my order block, and if that order block cause imbalance, the imbalance is very negligible. The imbalance, because the imbalance is just from this candle to this candle, so that imbalance is very negligible. But there is imbalance is there. There's imbalance. There's imbalance. There's imbalance. There's imbalance is there, and mitigation has already took place because it was the high. The high was mitigated here to take price up. That is just imbalance. That is just how you know imbalance. That is just how. And presently now, what so looking at the chart presently now, I expect my next high of the next candle should come to this point, should come and fill this last low of this first candle. Then the imbalance for this candle is already filled. Is already filled. That is just the simple concept of imbalance. That is just how we know imbalance. So when we talk of mitigation, mitigation we use to make now. Think about imbalance and mitigation now. When price was at this point, when since the bank can't lose money, when price was still at this point, there are many pending buy orders, there are many pending sell orders, because SMC traders, we believe that price might continue down. We believe that price might continue down. So at this point here, at this point here, there are still some sell orders stacked here. But as you can see, price started going up. So the SMC traders, they are already in loss. They are already in loss. So what can they do to make them be in break even is that they will carry the price after price has gone high for a certain time. They will carry the price back to that point, back to that point, to give them a break even, to give them break even, to back to that point, to give them break even. Then rally, then they will, at this point now, they will be in break even. They are not losing. All the sell orders that were here, all the sell orders, because as it's going up, it's really minus, they are losing money. But since they don't want to lose money, they have to mitigate that point, that low. They have to mitigate that low. They have to, and you can see price will come back all the way, mitigate it, then take them go up. That is just the simple concept, the simple analogy of mitigation. It's as simple as that. So presently now, this point now, this point now, at this point, there's pending buy orders here. There are buy orders here. And let's say at that top there, at that zone, there is buy orders. So and price is currently at this point. So they are currently losing money. So to mitigate it, they expect price to rally back up to get to that point, at least to make them in break even, then bring price down. It's as simple as that. It's as simple as that. It's as simple as that. There's always mitigation. There's always mitigation. Mitigation always happen. Mitigation always happen. Let me go to the weekly. Can you see? Can you see? Can you see what I'm saying? Price came back up, went up, rallied down, mitigated this low here because they are pending sell orders, so they are in loss already. So price came down, at least to some, their loss will be minimal or none here. Then price still went back. There's buy orders here, but since the market is coming down, they're already in loss. So price mitigated to give them break even, then went further down, then taking price up. Price went to this point. Price went to this point. You can see rallied down to almost break even to this mitigated this point. Still went up. You can see now went up to this point. There are others here, they are already in loss, mitigated that point again, gave them break even, then you can see price going up. So I expect price to mitigate this point to go up. It's as simple as that. That it's as easy as that. That is just the simple concept of mitigation. That is just the simple concept of mitigation. Price needs to fill all the orders. Price needs to fill all the orders in the market to know, to bring them at break even. Those banks, to bring them at break even. make them at break even. So I think that will be all. So tomorrow I'll be doing recap on everything, bringing a strategy that incorporates everything together. I think that will be that.